So if we look at inflation, which is obviously the key metric that everyone is worried about. So, the underlying US inflation finally seems to be easing. We've seen headline inflation in October dropping to 7.7%. This is in the US. This is well down from a peak of 9.1% in June. So, directionally, we're heading in the right direction. Now, more importantly, core inflation, which excludes food and energy prices, came in slower than expected at 0.3% month on month, or 6.3% year on year. Now, obviously inflation is a lagging indicator. And since June, we have seen key inflation inputs such as used car prices, household furnishings, medical, gasoline, freight rates, and even industrial commodities reduced significantly from their peak. For example, if you look at the chart on the right, this is the freight or container price from Shanghai to LA. And as you can see, pre-COVID, this was trading sub $2,000 to ship a container. It reached a high of 12,000 US dollars, early last year, and that's pretty much come all the way back down to around that $2,000 level, which is kind of where it was pre-COVID. So, this is actually quite material because, for example, when retailers or wholesalers import goods, the freight prices can be quite material input costs for them, which they obviously have to pass on. So we're seeing all these things reverting back to sort of where they were, and I think that's going to show in the inflation figures over the next few months. Now, as US goods inflation, has rolled over in a sense, this tends to lead services price inflation, which are a bit lagging. And we expect to see those obviously start to move down as well. Now, one of the key input metrics into the CPI figure is housing rental costs in the US. That represents pretty much a third of the CPI, but we believe that those figures are going to reduce materially over the next 6 to 9 months in the US as rental expectations, which is how they use to sort of measure this figure, adapt to the current reality of the housing market, which is really starting to come down, and rents will follow. So I think that will start to show within that inflation metric over the next few months, which will take it back down dramatically. Now in Australia, we lag in the US by at least 6 months. So we're going to see inflation actually go higher over the next few months before it peaks and then comes back down. But I think it will follow the same trajectory as in the US, just with a 6 to 9 months lag. So, a lot of people asking, so when will inflation come down? So, if you look back in history, if you look on the table on the right, history has shown that every period the US has entered a recession with inflation above 3%. The resulting sharp downturn in the economy did bring inflation down. Now, on average, it took about 16 months to slow the CPI from a peak to 2%. And that peak to trough reduction in CPI has been on average 6.8%. So if you think about it, we peaked from an inflation point of view in the US, we peaked in June this year. And so we really expect the end of next calendar year to sort of see inflation really come back down dramatically, where I don't think it's going to be even sort of a dinner table discussion anymore. So we're expecting the markets to turn positive next year as rate rise expectations will begin to reduce and come down significantly, and then investors will start pricing an earnings recovery in financial year 24. And so because the markets are forward looking, we think next year will be a really good year for equities once we start seeing those figures come down and interest rates pause. So if we look at interest rates, over in the US, interest rates have risen to a range of 3.75 to 4%. And in Australia, we're sitting at 2.85%. Now, there are further rate rise expectations in the US. The market is expecting 50 bips in December, and then another 50 bips rise in February 23 next year, and finally at 25 bips in May, followed by a pause. And then potentially the market is pricing in even a rate cut from November next year. Now, again, Australia is 6 to 9 months behind the US, but what's going to drive markets is really the US. So, you know, we think that inflation will keep trending lower, and the Fed has admitted recently to the lagging effect of rate hikes and the impact they have on the economy. It does take time to filter through. So we think that the Fed will pause rate rises as early as about March next year. And this will be a material pivot in expectations, which will drive a market rally next year. Now, if you look at the chart below, basically it shows that the average historical market rally following an aggressive rate rise cycle, which we just had, once the Fed pauses, the market tends to rally by at least 20%. It happened in the 80s and 90s. It happened in early 2000. It happened, you know, before the GFC. Also happened, if you recall, exactly 4 years ago when I joined TAMIM in late 2018, and then we had quite an amazing, you know, year. Obviously, COVID came about and went, and then now we're sort of looking at a similar situation. So we believe that when the Fed will pause at some point early next year, 2023 will be an amazing year for equities, which is why you really want to be invested in the market. And then from a valuation perspective, you know, if we look at the S&P 500 PE multiple, it's currently sitting at around 16.5, 16.8 times. Sorry, yeah, it was down last night, so it's around that mark. And the ASX is about 14.5 times. You know, that's sort of around that sort of long-term average multiple for the market. So, you know, it's the markets aren't extremely cheap, but they aren't expensive either. So we think they're sort of fair value, and it really is more of a stock pickers market than anything else. Now, I think we do think that volatility will remain over the next few months until those rate rise expectations normalize, and those you know, volatility will come down. You know, I think earnings expectations for next year will have to adjust as the economy slows down pretty much everywhere around the world and in the US. But actually, you know, usually when a recession is announced, markets have already rallied quite hard because the market is always predicting what's going to happen. So, you know, if we look at the US investor sentiment, it's a bull-bear spread on the right side. We're seeing that investor sentiment at the moment is still really bearish. In fact, it's almost as bearish as it was back in early to late 2020 post the COVID meltdown. So, you know, if you look at historically, these are actually great buying indicators. And so we think this is setting up for a really good year next year. So, you know, if we go back to the ASX and our portfolio, I think obviously this was a very tough year for markets, especially for many growth stocks and small caps. You know, we've seen share prices, you know, get materially sold off, and you know, that has sort of led to a lot of M&A and takeover activity really heating up. Obviously, there are, you know, a few reasons for that. We're seeing the Aussie dollar quite weak, especially against the US dollar. So for those overseas US dollar companies, it's a lot cheaper to buy Australian businesses. And also, I think we've seen valuations reach a point where they're so depressed, so cheap that, you know, companies, you know, are seeing the value to buy these businesses now and really reap the benefits as profits and the economies recover over the next few years. So, in our portfolio, we've actually had a really good long-term track record of inbound takeover activity in the portfolio in the last 4 years. In this calendar year alone, we've already seen 6 takeover offers for our portfolio holdings. So salmon producer Tassal, we started buying that at 360. It got a takeover bid eventually from a large competitor called Cook Inc. at $5.25. That's done. Software business called Nitro, which does digital documents and signatures. We started buying that around $1.50, and that's currently seeing a bidding war between 2 players, Aludo and Potentia, at $2. We think that will end up 10-20% higher. Another company that we've owned for over 3.5 years, called ReadyTech. Initially back then we bought it around $1.20. That received a takeover offer from private equity firm at $4.50, and it's going through a due diligence process. PushPay is one that we bought only a couple of months ago at 90 cents, and that got a deal done at $1.24. Another one recently, only a few weeks ago, MSL Solutions, and that one we started buying that at 14 cents, and that got a cash bid at 29.5 cents from a private equity firm. And then another one, Elmo, which is a software business for the recruitment industry. We bought that at about $3.30, and that's got a $4.85 bid, which is in process to completion. So what we've noticed is that the key criteria for most of these companies have is they're all growing their top line. So businesses that are struggling to grow top line or losing top revenue growth, they're not really on the radar. So want top line growth. All these businesses are profitable, or in the case of some of these technology companies, they're on the cusp of break even or profitability. And then just depressed valuations. The ones that are loss making, they're usually trading on sort of 2 to 3 times sales multiple, and they're getting bids around that 5 times or more. And then the ones that are profitable usually have traded around that sort of single digit profit multiple, and they're getting sort of anywhere between 15 to 20 times profit multiple in the case of a takeover. So there's a few more companies, we get asked, who's potentially next. There's a few companies in our portfolio which we think are going to get taken over. There's 3 companies which I think are highly likely to catch a bid in the next few months. The first one is Janison Education. So they're a education software business that we've owned for a while. $45 million of revenues. They're sort of growing at 25% per annum top line. They're actually profitable. They'll make about $6 million EBITDA this year. And they've already received and confirmed to the market in the last few weeks that they've received expressions of interest for the business. We think in the case of a takeover, it will probably go for about 90 cents. Another company that we've owned for a while is Early Pay. So they are sort of the second largest non-bank invoice funding business to small, medium-sized businesses. They do about $3 billion per year. This year is a bit of a transitional year. They'll only make about 11 mil of net profit after tax, but we expect that to bounce quite hard into FY24. In the meantime, they've confirmed that they'll keep paying their dividend, which equates to about a 12% dividend yield. Now they're 19% shareholder, which is another listed company called Consolidated Group, or COG. We know that they've tried to buy Early Pay prior to COVID. We think they're going to come back. There's significant synergies in combining those businesses. And we think that most likely a bid will probably be around that sort of mid to high 50s, which is about a 50% premium to the current share price. And then finally, Tyro. They're an FPOS terminal provider in Australia. They've got about 68,000 terminals. So they're the 5th largest after the banks. They got a $1.25 offer from a private equity firm, Potentia. And we'd also know that Westpac is quite keen on acquiring them as well. We think that one will probably end up around that $2 mark, or maybe more. And so these are just just three examples of who we think might be next. But sometimes you really don't know who's going to catch a bid, and there's a few other ones that we'll talk about that have potential. So I'll talk about 5 stocks in the portfolio that we really like. Just explain a little bit about their business and where we think they're going. Um, all these businesses are profitable. You could regard them as growth stocks, but some of their multiples are all sort of trading as value stocks. So you can categorize them as you like. The first one is SmartPay. So SmartPay is actually similar to Tyro, just a little bit smaller. So they're the second largest non-bank merchant terminal provider in Australia after Tyro and New Zealand. And in Australia, they've got about 12,500 terminals in market, and they're currently annualizing about $5 billion in transactions. And they're on track to double that in the next 3 years. If you look at that sort of graph chart on the bottom right, it shows you the number of transacting terminals of SmartPay, over the last kind of 2 years, and the revenue on the left side. And as you can see there, they're growing really fast. In Australia, there's about 1 million terminals, but the small business addressable market is about 250,000 terminals. So at the moment, they've got 5% market share, and they believe that they can get to, and you can see from their current growth rates, they believe that they can get to 10% of that in the next 3 years. At that point, we estimate they'll do at least $160 million of revenues, and that should be somewhere between $40 to $50 million of EBITDA. So around 2025, the current market cap is $200 million, and they're actually in a net cash position. So as you can see, if they can get, if they can keep going, then the upside is quite material. Just to give you an idea, Tyro, is currently trading on sort of 20 times EBITDA because there's takeover speculation. So I think in a situation where someone will look to buy them, there's quite significant upside from here. This financial year has really been an inflection point from them. They've reached a scale where they're starting to generate free cash and post spending money on their growth capex, because obviously as you gain new merchants and you got to buy those terminals and put them. So the payback is about 3 to 4 months, which is quite attractive. And they're obviously a big beneficiary, with Australia seeing sort of tourism and coming back into Australia, people spend more. And obviously a big beneficiary of inflationary pressures. They earn a margin on each transaction that goes through a terminal. So as you can imagine, when businesses put their prices up due to inflation, SmartPay just clips a margin on a higher transactional amount. The managing director is a good operator. He's got good skin in the game. He owns shares in the company. And what's interesting, in New Zealand, they've got a little bit of a different model. They've got about 20% market share in New Zealand. Over there, they don't clip a ticket on each transaction. They just get a monthly rental fee because the industry structure is quite different to Australia. But for that division alone, they received an $80 million offer prior to COVID. And obviously that fell through, but we think that someone could come back to buy that off them, or if they could change that model in New Zealand and somehow get to benefit from a margin on transactions, then the upside is quite material. This year, we think they'll do about 80 million of revenue, $18 million of EBITDA. We think it's worth at least $1.20, and some of the key catalysts will be their guidance this year, and then potentially some corporate activity in New Zealand. The next one is a company called People In. They're about a 320 million market cap. They're the leading ASX listed, talent solutions provider. So founder-led business. They listed on the ASX about 6 years ago, and if you look on the right on those bar charts, they've consistently grown revenues at 27% per annum, EBITDA 28% per annum, and PAT-A, earnings per share. They pay good dividends. So really one of those consistently delivering kind of business, which is what we like. They've got a history of M&A, and they usually tend to acquire 1 or 2 businesses a year. And they seem to be quite measured with their acquisition strategy. So they haven't done anything silly or gone too aggressive, and it's really worked for them. Their balance sheet could probably support another $30 million of deals. But we think that the reality is they will probably want to raise money and do bigger deals, and what's holding them back is the current valuation and share price, which I'll come back to in a moment. If you look at the actual business itself, it's diversified really well, both on a sector level and on a geographic level. In Australia, they're in health, IT technology, accounting, and industrial. So if one industry is sort of in a downturn, it doesn't impact the business as much. Again, a big inflation beneficiary, as we see wage inflation, especially the minimum wage going up. People earns a margin on wages, so they just make more money. We know that job vacancies all-time high. There's big demand, and with the border reopening this year, we're seeing more and more that the talent pool is increasing as more and more immigrants come into the country, and so it only benefits people in increasing that talent pool. Trading on a really attractive valuation. They're currently on about 6 times EV to EBITDA, or a P multiple of 9 times. And we think it's too cheap for this kind of business, and the board and management thinks the same. They've initiated last week a strategic review, and basically what they're saying to the market is that if the ASX is not willing to give them a fair multiple, then they will probably look to sell this business to maybe a private equity, and keep growing in private hands. So I think that the way we look at it is that it's very cheap, it's growing, paying a good divvy. If the market won't re-rate it, then someone will take it out, and we think it's worth about $5. So we think there's really good upside here in the short and long term. The next one is a company called DGL Group. They're about a 400 mil market cap. Quite a unique business on the ASX. There's not many sort of similar type businesses. They've listed actually about a year or a year and a half ago. And it's a founder-led business. The managing director owns 55%, which we really like. Now, what do? They're essentially in the chemical logistics, formulation and warehousing provider. They provide those services in Australia and New Zealand. They're sort of building a one-stop shop to service large national clients, whether they need to store chemical, to waste processing, and any manufacturing of special formulations and so on. Now, there's quite a significant competitive moat that they've built through various licenses, environmental licenses, and so on, and a lot of property that they've owned as well. They have about $150 million of property that's owned on their balance sheet. They are a very acquisitive business. They've acquired quite a lot of businesses over the last 18 months, really building that sort of national footprint as that sort of one-stop shop provider. Now they're a bit of a beneficiary of that crisis that's happening in Europe at the moment. High energy bills is leading to a lot of key sort of chemical manufacturers in Europe, which a lot of companies import into Australia. Obviously those are shutting down manufacturing plants because it's not really profitable to keep going with such high energy bills. We see them as a big beneficiary as they built up quite a significant inventory base, and they will be able to continue to service large customers in Australia, while smaller customers I think will struggle to source some of those key chemical ingredients. So we see them as a big beneficiary of this in the short term. And this business last year did 370 mil revenue, 66 mil EBITDA. They've given guidance this year for about $72 million of EBITDA, and we think it's worth about $2.50, so about 50% upside. And I think the key catalyst is really delivering on that guidance this year and showing the market that they can generate some really good operating cash flow this year. And I think obviously further acquisitions, because they will keep acquiring businesses and grow. So I think that the founder, which owns over half of this business, keeps buying shares on markets, which is a really good indication of what he thinks the business is going to. So it's one that we really like. Next one is a company called IPD Group. They're about 260 mil market cap. They listed a year ago at $1. Sorry, and this is where we started buying the stock. Now they're kind of like another way to playing that EV kind of renewable transition into electric vehicles. They provide complex electrical components and they distribute those in Australia. They've got partnership with the large international brands in that industry, and they distribute those in Australia. Now they've got a really good history of profit growth, and they pay dividends as well. As you can see, they've been growing their EBITDA consistently over the last 4 years, and they had their AGM yesterday, and they've given guidance that EBITDA will continue to grow at about 15 to 20% this year. And management are the largest shareholders, which is really good. And they've got a strategic partnership with their largest supplier, a company called ABB, and that's in the EV charging sector in Australia. So as ABB rolls out EV charging stations around Australia, IPD has the contract to service and provide all the components into that. So obviously that's a big and growing industry. Penetration is quite low in Australia, but that's only going to grow. And so there's really good tailwinds there. And then also that whole renewable transition, that infrastructure spending on renewables, there's a strong tailwind for electrical cable demand, and that's going to play really well into IPD. So they've already upgraded profit twice during this calendar year, and then they've upgraded again yesterday at the AGM. Last year they did 12.5 mil NPAT, 180 mil revenue. They just forecasted revenue to be around sort of 220 this year, and NPAT will grow by at least 20%. They have no debt. They have at least 25 mil net cash on their balance sheet. So we think acquisitions are really key. Will be very accretive because they won't have to raise equity. They can use cash and even debt. So I think really good business, and our valuation is $3.50. And the last stock we'll talk about is a company called Close the Loop Group. They also listed last year, about 135 mil market cap. Essentially, they're a global provider of waste recycling and packaging. So they've got about 260,000 global collection points, and they've established a really strong moat, and they actually get paid money from collecting all kinds of recyclable items. Think of your print cartridges, to makeups, to crayons, to all kinds of materials that need recycling. They actually get paid to collect those by those companies. And then what they do is they've developed quite a lot of R&D and their own intellectual property into sort of different solutions for this recycled waste. And then, as you can see from that picture, they can turn that into products which they obviously sell on. So for example, a really successful product that they developed is called Toner Plus. So all those print cartridges, they recycle those, and they create some sort of a replacement to asphalt, for roads, which actually has really long longevity, and it's really catching on within the industry. They've got a contract with Downer EDI, and that could, it's still small in terms of revenue wise, but that could continue to grow. And they're doing that in other sectors as well. They're seeing strong demand from supermarkets, pet food, the battery industry of when people dispose their mobile phones and so on. So the whole train, that ESG economy beneficiary, there's probably one of the probably the highest ESG rated stock on the ASX, I would argue. They've got a good focus in the US. So I think 40% of their revenue comes out of Australia, and that's going to grow. Last year they did $90 million of revenues, 14 mil of EBITDA, and they actually generate really good cash, strong balance sheet. This year we estimate they'll make about 110 mil of revenue and just under 20 mil of EBITDA. So they're trading at about 7 times, which we think is quite cheap. And again, the management and board have really good skin in this business. They're the largest shareholders. We think it's worth about 55 cents. And the key catalysts are acquisitions in the US to expand that part of their business. And then when they give guidance in February for the full year, I think it will be quite good. So, those are just sort of 5 stocks in the portfolio that we like, all profitable, all trading on very low multiples, and I think they're all going to do well regardless of sort of what happens in the economy.
Thanks, Ron. I might just ask you just to mute your speaker. Thanks. So I'm just going to move through now. We obviously have quite a number of questions coming through from the audience. If you feel as though you'd like to ask a question, please take some time, click on the Q&A button and ask some questions from Ron. So just prior to answering a few of those questions that we have already on screen, we just wanted to run through both portfolios and give you an idea of how these have fared since Ron took over the management of them, going back to the start of 2019. Obviously, the 2022 year has been extremely difficult, pretty much across the board for most Australian equities, barring potentially the top end of the market in the banks and some of the material stocks. But if you look at the all-cap portfolio through 2019, 2020, and 2021, some really strong returns coming through there. Obviously, 22 has been a more difficult year, but in comparison to what we're seeing out there across the smaller and mid-cap section of the market, although it is down and it has been a tough year, it is understandable in terms of what we've seen through that segment of the market. Alongside the all-cap portfolio, you've also had the small-cap income portfolio generating some really strong returns. Again, 22 has been a tougher year, but across both of those portfolios, as you've seen in that earlier slide, Ron has managed to annualize around about that 13% return per annum. Quite important to remember with investing, and this is something that we see across investors and across years. Normally what happens is all return profiles of all investments revert to mean. So there's going to be periods in the cycle where you're going to be getting returns which are higher than the long-term mean generated by that particular investment profile, and there'll be points in the cycle where you're below those. And typically, one of the things that we find is a very successful strategy is where you find that particular investment at a point in its cycle where it is trading or performing lower than its normal return profile. Those are generally very good periods in time to be investing into those investment solutions. We believe that's potentially one of those periods for the Australian equity portfolios. So really important to have a thought about that. Before I head across to the Q&A, I can see there have been quite a number of questions around the structure of the unit trusts, both the all cap and the small cap. So I might give you a quick rundown of what those investment parameters are. So for those of you who remember, It's housed within an unlisted unit trust structure. The minimum investment, we've actually reduced that down to $100,000. So if you'd like to take advantage of that lower minimum investment amount, $100,000 is what that is. Management fees come in at 1.25% per annum. And there is a performance fee of 20% in excess of the hurdle, which is actually the greater of the RBA cash rate plus 2.5% or 4%. There is no lockup period across any of the portfolios, and applications can be made on a monthly basis. Redemptions are also monthly with a 30-day notice period. We do also expect distributions to come through on a semi-annual basis. However, it's important to note that that is dependent on distributable returns being available within the unit trust structure. So hopefully that answers quite a number of the questions around the structures of the portfolios. If not, please just give me a nudge on the Q&A button and I will come back to them again for you. Ron, I might ask you just the first question here. I can see there've been a few of them, so I'm going to paraphrase as we go along as well. Certainly a few questions around your strategy that you've talked about a fair bit around energy. I know you've held some coal exposure through the course of this year, and really a question around that coal exposure, those investments. Is that something that you're still interested in? Do you still believe that that's something that will perform strongly going forward? And how are you viewing that in the portfolios at the moment?
Yep, thanks, Darren. Yeah, look, definitely, that whole energy thematic, we call it a sort of once in a lifetime energy crisis that's played out over the last few months, has really benefited Australian coal producers, mostly in thermal coal producers. We saw that playing out a few months ago, and we positioned the portfolio quite aggressively in sort of the 2-3 largest and most profitable thermal coal miners in Australia. Those companies were trading on 1x EBITDA or profit, significant cash flows, and each one had a different strategy in capital management. Some were more focused on dividends and others were more focused on buybacks. But at the end of the day, it doesn't really matter as long as they're trading on such low multiples, and giving that back to shareholders through various capital management initiatives was really the thesis behind it. And now those stocks, since we bought them, have more than doubled. And obviously, with the price of thermal coal peaking at sort of $400 a ton this year, it has come back a bit in the last few months. In the last month or so, we did take advantage of the share prices rallying quite hard, and we did reduce and take profits across those positions quite significantly. We still have exposure to those companies in the portfolios, but obviously not as much as before. We think a lot of the easy money has been made, but we still think that based on the lack of new supply or new mines coming on board, and that whole government transition to renewables with such strict timeframes, I think that will keep coal prices higher for longer. And especially going into that European winter now, I think we'll see those stocks continue to do well. And the key is really, if they keep paying us those big dividends or buying back aggressively, then we could still see more upside. So we still have exposure, but we took a lot of profits in the last month or so.
Thanks, Ron. So just a few questions in here around how you go about managing the overall portfolio. But I guess, again, just paraphrasing a number of those, how many companies would you hold in the portfolio? And then what is your view around how you put that portfolio together? Do you keep that number consistent? Are you buying and selling on a regular basis? How do you manage the portfolio across time?
Yep, sure. So, on average, we own between 30 to 40 stocks in each fund. There's probably only a 20 to 30% overlap. So they are quite different, and it has shown in the returns as well, or both have performed well. We really are looking for businesses that meet a lot of our fundamental investment criteria. So We want businesses that have really good tailwinds, that are growing, low levels of debt, profitable, and we're looking for businesses that are really sort of disrupting the industry. And especially in that small cap space, we spend a lot of time meeting and talking to management and trying to see whether these are people that we can back, whether they have skin in the game or incentives to grow the business. And then obviously we are always finding new opportunities. We've signed a lot of new great opportunities in the last few months. And so, we tend to sort of balance out, if companies look a bit expensive to us or they had a good run, we tend to be aggressive in taking profits. If we think the fundamentals have changed and they're no longer what they were when we first bought the company, then we will sell out. And obviously, we sometimes you want to exit a company quickly because things are going bad, but sometimes you just want to take profits gradually. And so as we are exiting some stocks, we might be building a position in new companies. So you might have a bit of an overlap in terms of exiting some positions. In the meantime, you build up your positions, because again, the same way you exit a company, you want to build up your position slowly into a company as you gain more conviction, or potentially get it at a lower price. So that's kind of the strategy across both funds.
Thanks, Ron. So here's definitely a question that was expected. And given that we've been fairly vocal on the stock through the years, few questions around EML and what's obviously transpired and occurred with them over the last 6 to 12 months. Do you want to give your thoughts and maybe even just a bit of a history around how long and how you've managed to actually buy and sell that stock?
Yeah, sure. So good old EML. So look, first of all, EML is just one stock within another 40 stocks within the portfolio. We actually did really well on EML. We bought that in early 2019 around $1 or $1.10, and we rode it all the way up, and we took profits along the way. We bought back, we took profits, so we did trade the stock over the years really well. This year, unfortunately, we lost money on the stock back in May or June this year. Obviously, we didn't expect the company CEO to resign abruptly. Obviously, he couldn't work with the current board. The business received several takeover offers, which we always saw the value in the company. They received the takeover offer at $5 earlier this year. That was confirmed by market rumors in the Financial Review. Then they received another couple of offers above $2 back in July. Again, that was confirmed by the Australian Financial Review. The problem with this company was that the board and the chairman weren't interested in selling this business, and which is why I think the CEO resigned. And obviously with the current issues they have with the Irish regulator, I think investors punished the stock, and so the moment that the managing director, which was the guy that we were backing, left, we decided to exit the stock, and we just took our loss and we moved on. We did that in at $1 something. So we did a lot better than where the share price is now. And then we continue to sort of watch from the sideline. And recently, the chairman last week got voted out at the AGM, which we saw as the key catalyst to get change into this business. So I think we're seeing some activist investors from the US come on the register now, and I wouldn't be surprised if the entire board will be removed, including the new CEO. And we could either see a breakup, a takeover offer, or just installing a new management team and a board that knows what they're doing. And we think that the actual value in this business, in the right hands, is worth multiples of the current share price. And so now we think that EML is an investment grade again, and so it becomes interesting again. And the good news is that nobody likes the stock, which is exactly the time that you want to buy a company like that. So still a lot of work to be done and to see what happens, but I think a lot of has changed. And again, it's just one position that we actually did really well on over the years, except this year, within a portfolio. So yeah.
So Ron, just to clarify that one for the audience, are you a holder or not a holder of EML anymore?
So since the AGM, once the chairman was voted out, we became holders again. There you go.
Thanks, Ron. Good to know. Okay, slightly different tack. What are your thoughts on SRG Global as a business? Obviously, slightly different to most in that area. That they've been able to build a recurring revenue stream. What are your thoughts there?
Yeah, SRG. I think it's probably one of the sort of highest quality, small cap contracting business on the ASX. We don't tend to invest in contracting businesses. We don't like that sort of lumpy nature of their business model and revenue visibility. But SRG has really turned the business around in the last few years. They've actually built a kind of recurring revenue maintenance services business where about 65, 70% of the revenue right now is sort of maintenance and that it sort of recurs every year. Very profitable, strong balance sheet. We bought that, we own that in a small cap income fund. So they're both growing earnings and paying dividends, which are growing every year. We think it's trading on about 11 times PE this year. And if you look at some of the better managed, maybe slightly bigger market cap contractors, some of them are trading on sort of 14, 15 times PE. So I think over time, as they keep proving themselves, the stock will re-rate or someone will acquire them. So we think it's worth 90 cents, maybe $1. So really good business, and we've done. I think we're up like 50% on the stock. So it's been a good one.
Thanks, Ron. Looking at the time, we've probably got space for one more question. I'll probably give you a tough one to end it off. And then just for everyone else, there's probably about 10 other questions out there that we haven't been able to get to. We'll get back to you each with responses to those questions. But yeah, just to end it off from your end, obviously 22 a difficult year. Do you feel like you've been able to take any lessons out of the year and in terms of how to get better at what it is that you do, and what could those lessons be?
Yeah, sure. So, there's no doubt that this calendar year has been a tough one. I think both for the markets and for us as well. The way I look at it is that, I've been investing for just under 20 years now. And, I've been through a lot of market crises, the GFC, all kinds of meltdowns and everything in between. And this is just another year of the classic investor concerns about this time it's inflation and interest rates. Another time it's something else. There's always some concerns on the horizon. But at the end of the day, and the key really to performance is that you continue to focus on the fundamentals of each company that you own. You obviously try and avoid businesses that have got issues or are struggling. And sometimes you do step on what we call a few landmines, and it's inevitable, and everyone gets a few stocks wrong. You try and minimize those, and you have to keep going, because as Darren mentioned before, the best time to invest in a stock is not after it's gone up 20 to 30%, but it's when it's down 20 or 30%, as long as the fundamentals are intact, because you're going to make more money buying that stock when it's down, not when it's already up. And I think it applies to a fund manager as well. If you look at our performance now over the 4 years since I've joined, and you still, after such a bad year, we're still averaging double-digit net of all fees, annual returns. I think this is the time to invest, because at the end of the day, like Darren said, you revert to the mean, you keep focusing on the fundamentals of the businesses that we own, and eventually, sentiment changes, the market re-rates, stocks re-rates, and we're going to continue to find new opportunities and businesses that are going to do well, and we'll get a few wrong along the way. And you can change your mind once in a while. And I think next year will be a really good year for equities. I think it will be a very good year, and you want to be invested, and probably the next few months is the time to get set. And I think we can continue to do 15-20% per annum net of fees, over the long term. So you want to, the way I see it, you want to buy into markets, into stocks, or into fund managers when after they're down, not when they're up. So that's really kind of my view on what's going on.
Brilliant. Thank you so much, Ron. And thank you everybody for joining us for today's webinar session. I think we might look to conclude proceedings at that point, and we'd like to thank you for your time. Enjoy the rest of the day.
Thank you, everyone. Have a good day.